Today we're diving into a topic that affects all of us: inflation. It's not just an economic term, it has real implications for our everyday lives. Stick around as we explore 13 ways inflation impacts us, along with some practical solutions to navigate through it. First up, let's talk about the cost of living. Inflation, often referred to as the general increase in prices of goods and services over time, directly impacts the cost of living for individuals and families. When inflation occurs, the purchasing power of money decreases, meaning that the same amount of money buys fewer goods and services. This phenomena affects essential expenses such as groceries, housing, transportation, and healthcare. For example, consider the cost of groceries over the years. What once bought a full cart may now only cover half. Similarly, housing costs have skyrocketed in many areas, making it increasingly difficult for individuals to afford suitable accommodation. This rise in living expenses puts pressure on household budgets, particularly for those with fixed incomes or limited financial resources. According to data from the US Bureau of Labor Statistics, the Consumer Price Index (CPI) is a commonly used measure to track changes in the cost of living over time. The CPI reflects the average price change for a basket of goods and services typically purchased by urban consumers. By analyzing CPI trends, economists can assess how inflation impacts the affordability of essential items for households. As the cost of living continues to rise, individuals and families may need to adjust their budgets, seek out more affordable alternatives, or explore additional income generating opportunities to maintain their standard of living. Understanding the impact of inflation on the cost of living is essential for financial planning and decision making at both the individual and policy levels. Next, let's discuss savings erosion. Inflation doesn't just affect the cost of goods and services, it also erodes the value of savings over time. When prices rise, the purchasing power of money diminishes, meaning that the same amount of savings can buy fewer goods and services in the future. This phenomenon, known as savings erosion, poses a significant challenge for individuals who rely on their savings to meet future financial goals such as retirement or education expenses. To illustrate, consider an individual who saves $10,000 in a bank account with a 2% annual interest rate. If inflation averages 3% per year, the real value of that $10,000 will decrease over time. After 1 year, the nominal value of the savings may increase to $10,200 due to interest, but the real value would only be equivalent to $9,903 in today's dollars, accounting for inflation. Over several years, the erosion of purchasing power becomes more pronounced, highlighting the importance of considering inflation when planning for long-term savings goals. According to Investopedia, investing in assets that offer returns higher than the inflation rate is essential to preserve the purchasing power of savings over time. Examples of such assets include stocks, real estate, and commodities, which have historically outpaced inflation and provided a hedge against savings erosion. Additionally, individuals may consider inflation-protected securities, such as Treasury Inflation-Protected Securities, also known as TIPS, which adjust their principal value based on changes in the CPI to provide a measure of protection against inflationary pressures. Inflation can pose significant challenges for individuals on fixed incomes, such as retirees or those receiving fixed salary payments. While their incomes remain constant, the cost of living continues to rise, leading to a decrease in purchasing power over time. This discrepancy can result in financial strain as individuals may find it increasingly difficult to afford essential expenses such as housing, healthcare, and utilities. For retirees who often rely on fixed retirement savings or pensions to fund their living expenses, inflationary pressures can have long-term implications for their financial security. Without adjustments to account for inflation, retirees may see a gradual decline in their standard of living as the real value of their income decreases over time. To address these challenges, individuals on fixed incomes may need to explore strategies to mitigate the impact of inflation. This could include investing in assets that provide inflation protection, such as Treasury inflation protected securities, also known as TIPS, or annuities with inflation adjusted payouts. Additionally, individuals may consider seeking out employment opportunities or supplemental income streams to supplement their fixed incomes and offset inflationary pressures. Inflationary pressures can lead to employment uncertainty as businesses navigate rising costs and changing market conditions. When prices rise, businesses may face increased operating expenses, including higher wages, raw material costs, and borrowing costs. In response, businesses may implement cost-cutting measures such as reducing labor costs through layoffs or hiring freezes to maintain profitability. Additionally, inflation can impact consumer demand and purchasing power, leading to changes in production levels and employment opportunities across various industries. For example, industries that rely heavily on discretionary spending may experience fluctuations in demand during periods of high inflation, leading to job losses or reduced hours for workers. According to research from the Federal Reserve Bank of San Francisco, there is a negative relationship between inflation and unemployment, known as the Phillips curve. This relationship suggests that as inflation rises, unemployment tends to decrease, and vice versa. However, the relationship between inflation and unemployment is complex and can vary depending on other economic factors and policy interventions. To address unemployment uncertainty during periods of inflation, policymakers and businesses may need to implement strategies to support job creation, economic growth, and stability. This could include monetary and fiscal policies aimed at controlling inflation, supporting small businesses, and investing in workforce development and training programs. So viewers, if you haven't subscribed our channel yet, please like, share and subscribe our channel now. Inflation has a direct impact on interest rates set by central banks. When inflation rises, central banks may increase interest rates to curb inflationary pressures and maintain price stability. Higher interest rates make borrowing more expensive, which can slow down economic activity and reduce consumer spending. For example, when the Federal Reserve raises its benchmark interest rate, banks typically increase the interest rates they charge on loans, such as mortgages, car loans, and credit cards. As a result, consumers may face higher borrowing costs, leading to decreased demand for goods and services and slower economic growth. Conversely, when inflation is low, central banks may lower interest rates to stimulate economic activity and encourage borrowing and investment. Lower interest rates make borrowing cheaper, leading to increased consumer spending and investment, which can help boost economic growth. According to the Federal Reserve, monetary policy decisions, including changes in interest rates, are guided by the dual mandate of maximum employment and stable prices. By adjusting interest rates in response to inflationary pressures, central banks aim to achieve their objectives of price stability and sustainable economic growth. To mitigate the impact of interest rate fluctuations on personal finances, individuals may consider refinancing loans and lower interest rates, locking in fixed rate mortgages, or exploring alternative financing options. Additionally, maintaining a diversified investment portfolio can help protect against interest rate risk and inflationary pressures. Inflation can have a significant impact on investment strategies as it affects asset values, returns, and purchasing power. During periods of high inflation, certain assets such as stocks, real estates, and commodities may provide a hedge against inflation and preserve wealth over time. These assets have historically outperformed inflation and provided investors with opportunities for capital appreciation and income generation. Stocks, for example, are considered inflation-sensitive assets, as companies can adjust prices and revenues to keep pace with rising inflation. Additionally, real estate investments such as rental properties or real estate investment trusts (REITs) can provide a source of passive income and potential appreciation in value over time, making them attractive inflation hedges. To protect against inflationary pressures, investors may also consider investing in commodities such as gold, silver, and oil, which have intrinsic value and can serve as a store of wealth during times of economic uncertainty. These assets tend to maintain their value or appreciate in price when inflation is high, providing diversification and downside protection in investment portfolios. Additionally, investors may consider inflation-protected securities such as Treasury inflation-protected securities, also known as TIPS, which adjust their principal value based on changes in the Consumer Price Index (CPI) to provide a measure of protection against inflationary pressures. TIPS provide investors with a guaranteed real estate of return, ensuring that their investments keep pace with inflation over time. Inflation presents significant challenges for budgeting as rising prices can impact the affordability of goods and services, thereby affecting household finances. When the cost of living increases, individuals and families may find it necessary to allocate more of their income towards essential expenses such as groceries, housing, utilities, and healthcare, leaving less room for discretionary spending and savings. Budgeting becomes more challenging during periods of high inflation, as individuals may need to adjust their spending habits and financial priorities to accommodate rising costs. This may involve cutting back on non-essential expenses, finding ways to reduce discretionary spending, or seeking out alternative, more affordable options for goods and services. It is essential for individuals and families to regularly review and adjust their budgets to account for inflationary pressures and changing economic conditions. This may include setting aside emergency funds to cover unexpected expenses, prioritizing essential expenses, and finding ways to increase income through additional source of employment or investment income. Additionally, individuals can take proactive steps to mitigate the impact of inflation on their budgets by seeking out discounts, coupons, and promotions, comparing prices across different retailers, and making informed purchasing decisions. By staying vigilant and proactive, individuals can effectively manage their budgets and navigate through periods of inflationary pressures. Inflation can exacerbate poverty by increasing the cost of living and making it more difficult for low-income individuals and families to afford basic necessities. When prices rise, individuals with limited financial resources may struggle to cover essential expenses such as food, housing, healthcare, and transportation, leading to a decline in their standard of living. The impact of inflation on poverty is particularly pronounced by vulnerable populations, including children, the elderly, and individuals with disabilities, who may already be living on fixed incomes or facing financial hardships. Rising prices can push these individuals further into poverty, making it challenging for them to escape the cycle of poverty and achieve financial stability. To address the impact of inflation on poverty, policymakers and stakeholders must implement targeted interventions to support low-income individuals and families. This may include expanding access to affordable housing, healthcare, and social services, increasing the minimum wage to ensure a living wage for all workers, and providing financial assistance and support programs to help individuals meet their basic needs. Additionally, efforts to address inflation and promote economic stability can help reduce poverty rates by ensuring that essential goods and services remain affordable and accessible to all members of society. By prioritizing policies that address the root causes of poverty and inequality, policymakers can work towards creating a more equitable and inclusive society for all individuals. Inflation doesn't just impact domestic economies, it also has implications for international trade. Fluctuations in inflation rates can affect exchange rates, trade balances, and global economic stability. When inflation rises in one country relative to others, its currency may depreciate, making its exports cheaper and imports more expensive. This can lead to shifts in trade patterns as countries seek to capitalize on changes in relative prices. High inflation rates can also undermine a country's competitiveness in global markets by eroding its purchasing power and increasing production costs. As a result, countries with high inflation may experience reduced export competitiveness and decreased demand for their goods and services internationally. To mitigate the impact of inflation on international trade, policymakers may implement measures to stabilize exchange rates, control inflation, and promote economic stability. This may include monetary policy interventions such as adjusting interest rates and managing money supply growth, as well as fiscal policy measures aimed at reducing budget deficits and controlling government spending. Additionally, international cooperation and coordination are essential for addressing inflationary pressures and maintaining global economic stability. By working together to address common challenges, countries can foster an environment conducive to sustainable economic growth and development. Inflation affects the cost of borrowing by influencing interest rates set by central banks. When inflation rises, central banks may raise interest rates to control inflationary pressures and maintain price stability. Higher interest rates make borrowing more expensive for consumers and businesses, leading to increased borrowing costs for mortgages, car loans, and other forms of credit. For example, when the Federal Reserve raises its benchmark interest rate, banks typically increase the interest rates they charge on loans to consumers and businesses. This can result in higher monthly payments for borrowers and increased overall borrowing costs. Conversely, when inflation is low, central banks may lower interest rates to stimulate borrowing and economic activity. Lower interest rates make borrowing cheaper, leading to lower borrowing costs for consumers and businesses, which can help stimulate economic growth. To mitigate the impact of inflation on borrowing costs, individuals and businesses may consider refinancing existing loans at lower interest rates, locking in fixed rate loans to protect against future rate increases, or exploring alternative financing options. Additionally, maintaining a good credit score and shopping around for the best loan terms can help borrowers minimize borrowing costs and manage their finances effectively. So viewers, if you haven't subscribed our channel yet, please like, share and subscribe our channel now. Inflation influences various aspects of business decision making, including pricing strategies, investment decisions, and financial planning. When inflationary pressures are present, businesses must carefully manage costs, pricing, and production to maintain profitability and competitiveness in the market. Rising inflation can lead to increased production costs, including higher wages, raw material prices, and borrowing costs. To offset these cost increases, businesses may adjust their pricing strategies by raising prices on goods and services. However, businesses must strike a balance between passing on increased costs to consumers and maintaining affordability to remain competitive. Additionally, inflation can impact investment decisions as businesses assess the potential returns and risks associated with different investment opportunities. During periods of high inflation, businesses may prioritize investments in assets that provide protection against inflation, such as real estate, commodities, and inflation-protected securities. Financial planning is also affected by inflation, as businesses must consider the impact of inflation on cash flow, debt servicing costs, and capital budgeting decisions. For example, businesses may need to account for inflation when projecting future revenues and expenses, adjusting budgets and financial forecasts accordingly. To navigate through periods of inflation, businesses may implement various strategies, including cost-cutting measures, pricing adjustments, and hedging strategies to mitigate the impact of inflation on their operations and financial performance. Inflation can have a significant psychological impact on individuals and society as a whole. When prices rise consistently, individuals may experience feelings of anxiety, stress, and uncertainty about the future. Concerns about declining purchasing power, increasing expenses, and financial instability can contribute to heightened levels of stress and dissatisfaction. Additionally, inflation can erode consumer confidence and trust in the economy, leading to changes in spending behavior and investment decisions. Individuals may become more cautious with their finances, reducing discretionary spending and saving more to buffer against future uncertainties. The psychological impact of inflation extends beyond individual behavior to broader societal attitudes and perceptions. High levels of inflation can undermine confidence in government institutions, economic policies, and financial systems, leading to social unrest, protests, and political instability. To address the psychological impact of inflation, policymakers and stakeholders must communicate effectively, with the public, provide accurate information about economic conditions and policy responses, and implement measures to support financial literacy and resilience. By fostering greater understanding and awareness of inflationary pressures, individuals and society can better cope with the challenges and uncertainties associated with inflation. Inflation can have indirect environmental implications, particularly when it leads to changes in production and consumption patterns that impact natural resources, energy consumption, and pollution levels. As prices rise, businesses may prioritize cost-cutting measures over environmental sustainability, leading to increased resource extraction, energy consumption, and waste generation. For example, during periods of high inflation, businesses may reduce investments in renewable energy resources and environmental conservation initiatives in favor of short-term cost savings. For example, during periods of high inflation, businesses may reduce investments in renewable energy sources and environmental conservation initiatives in favor of short-term cost savings. Additionally, consumers may opt for cheaper, less environmentally friendly products and services, further exacerbating environmental degradation. To address the environmental impact of inflation, policymakers and businesses must integrate environmental considerations into economic decision-making processes and policy interventions. This may include implementing regulations and incentives to promote a sustainable production and consumption practices, investing in renewable energy infrastructure, and fostering greater awareness of the environmental consequences of inflationary pressures. By integrating environmental sustainability into economic policies and practices, stakeholders can work towards creating a more resilient and sustainable economy that balances the needs of people and the planet. In conclusion, inflation is a pervasive economic phenomenon that affects individuals, businesses, and societies in numerous ways. From the cost of living and savings erosion to employment uncertainty and environmental impacts, inflationary pressures can have far-reaching consequences on our lives and the broader economy. However, by understanding the various ways in which inflation impacts our lives and implementing proactive strategies to mitigate its effects, individuals and policymakers can work towards building a more resilient and sustainable economic future. Through prudent financial planning, diversified investment strategies, and targeted policy interventions, we can navigate through periods of inflation and promote economic stability, prosperity, and well-being for all. By fostering greater awareness, collaboration, and innovation, we can address the challenges posed by inflation and build a brighter future for generations to come. And there you have it, folks. 13 ways inflation impacts our lives, along with some solutions to navigate through it. If you found this video helpful, don't forget to like, share, and subscribe for more content like this. Thanks for watching. Until next time, take care. Bye-bye.